Most beginners would look at this chart after the drop and say the sell was obvious. It was not. The trade became valid before the drop when 7 conditions lined up at the same time. In this lesson, I will show you those 7 rules, how the BYBT area of confluence completed the setup, and how to plan the risk before entering. This is educational content, not financial advice. Trading leveraged products involves risk. Rule number 1. Decide the market bias before looking for an entry. Start on the left side of the chart. Price is already moving lower, but one bearish candle is not enough to establish a sell bias. We need structure. The key clue is the lower high marked above price. Buyers tried to recover, but they failed to break the previous high. Price then moved down and broke the nearby support structure. That sequence tells us the market is accepting lower prices. When the structure is producing lower highs and lower lows, my job is not to predict the exact bottom. My job is to look for a technically valid location where sellers may return. This one decision removes many weak trades. If the bias is bearish, I stop treating every green candle as a new uptrend. A rally can simply be a pullback inside the larger sell move. Rule number 2. Mark support and resistance before price reaches them. The white line above the market marks the lower high resistance area. The yellow line below marks support and the first logical downside objective. These levels give the chart context. Without them, a trader sees candles moving randomly. With them, the trader can see where price previously changed direction, where orders may be concentrated, and where a trade idea becomes wrong. Support and resistance are not always perfect single prices. They are decision areas. That is why the BYBT model uses an area of confluence, or AOC, instead of pretending the market must react to one exact line. Rule number 3. Wait for price to pull back into the AOC. After breaking structure, price does not continue down in a straight line. It starts to recover. This is where beginners often make one of 2 mistakes. Some traders chase the sell at the bottom after the move is already extended. Others see the green candles and buy directly into resistance. Both decisions ignore location. The better approach is patience. Let price return to an area where the bearish idea can be tested. On this chart, the purple AOC combines the broken structure level, previous reaction, and the area where sellers previously controlled price. That gives us confluence. The pullback is not automatically the entry. It is price traveling toward the location where we will make a decision. Rule number 4. Demand confirmation at the zone. Look at the first test of the AOC. Price reaches the zone and reacts down. That response is useful, but it does not mean we should enter carelessly. Price later returns and drives deeper into the same resistance area. This second test gives us more information. Buyers can push into the zone, but they cannot establish acceptance above it. Price fails to close and hold beyond the AOC, then sellers step back in. That is the confirmation. Notice the difference between touching a level and rejecting a level. A touch only tells us price arrived. A rejection tells us that one side responded. For a sell, I want evidence that buyers are losing control at resistance. That evidence can include rejection wicks, bearish closes, a lower time frame break, or failure to hold above the zone. Confirmation will never remove all risk, but it can stop us from entering simply because a colored box exists on the chart. Rule number 5. Define invalidation before calculating profit. The red area above the entry is not decoration. It shows where the trade idea is invalid. If price breaks through the AOC, trades above the retest high, and begins accepting above resistance, the bearish setup has failed. At that point, staying in the trade because we hope price will return is not analysis. It is denial. The stop should be placed at the technical point where the setup is wrong, not at a random distance chosen only to increase the position size. Then the position size must be adjusted to match that stop. This is one of the most important Forex trading tips for beginners. Risk a small, consistent percentage of the account on each idea. Do not increase the risk because the last trade lost. Do not use excessive leverage because the setup looks perfect. No setup is perfect. Professional risk management begins with accepting that any individual trade can lose. Rule number 6. Plan the target using structure. The yellow support line below price gives us the first logical target. Why target support? Because that is the next area where buyers may respond and where the current bearish move may slow down. A target should come from the chart, not from the amount of money we want to make that day. Before entering, compare the distance to invalidation with the distance to the target. If the potential reward does not justify the risk, the correct decision may be to skip the trade. In this example, the sell entry is close to resistance, the invalidation is above the AOC, and the downside target is near support. That creates a structured risk-to-reward plan. As price moves in our favor, we still need a management rule. Some traders take partial profit at the previous low, others hold toward the main support level. Either method can work when it is defined before emotions take control. Rule number 7, execute the plan, not the candles. After the rejection, price begins moving lower. There are still green candles, there are still pullbacks. That does not automatically invalidate the trade. Beginners often exit a valid position because one candle moves against them, then re-enter after price continues. This creates unnecessary losses, extra spread, and emotional decision-making. The chart already told us the invalidation point. Until price reaches that point or the management rule is triggered, every small candle does not require a new decision. This is the difference between analysis and reaction. Analysis happens before the trade. Reaction happens when a trader has no plan and allows every price movement to change the story. Now let us combine the complete setup. First, price forms a lower high and confirms a bearish market bias. Second, support and resistance are mapped before the entry. Third, price breaks structure and pulls back instead of being chased. Fourth, the pullback reaches the BYBT area of confluence. Fifth, buyers fail to hold above resistance, and the zone produces bearish confirmation. Sixth, the stop is placed beyond the technical invalidation point. Seventh, the target is planned at the next support area, and the trade is managed according to the original plan. That is a complete trade idea. The entry is only one small part of it. Here are the 3 common mistakes this setup helps us avoid. Mistake number 1 is selling after the drop, far away from resistance. A good direction at a bad location can still produce a bad trade. Mistake number 2 is buying the pullback because several candles are green. Candle color does not override bearish structure. Mistake number 3 is using a large position with no technical stop. Leverage can amplify gains, but it can also destroy an account quickly when risk is not controlled. Before your next trade, use this 7-point checklist. What is the market bias? Where are support and resistance? Has price returned to a meaningful area of confluence? What confirms the entry? Where is the setup invalid? Does the target justify the risk? What is the maximum account risk if the trade loses? If one of those answers is missing, the setup is not complete. The goal is not to trade more. The goal is to make fewer decisions with better information. If you want to learn the complete BYBT trading strategy, the one-on-one private mentorship is linked in the description. You can also get the BYBT trading ebook at forexhash.com. For traders looking for a regulated trading partner, I have included my EBC Partner Link in the description. That is an affiliate link, which means I may receive compensation if you register through it at no additional cost to you. Always research any broker independently, understand the product, and never deposit money you cannot afford to lose. Comment below with the rule you struggle with most: bias, patience, confirmation, stop placement, or risk management. And remember, structure gives the direction, the AOC gives the location, confirmation gives the timing, and risk management keeps you in the game.